2022, what a real estate market that was. Am I right? Last year, I predicted buyer fatigue, a hike in interest rates, and I even warned multiple times of false appreciation. If you've ever seen my videos before, you know that I'm Adam with the Walker team from Intero, part of Berkshire Hathaway, here in the red-hot Silicon Valley, California, one of the most expensive and unique real estate markets in the world. Now let's use my psychic powers and consult my crystal ball to tell you exactly what is going to happen in 2023 in our local market. Who the heck am I kidding? There is no prediction this year.
Exactly.
Homer's reaction is spot on. However, I can share a few predictions and likely scenarios that we are probably on course for this year. A little background, before putting this video out, dozens of hours of research went into making this video. I pulled all the various national experts' projections, culled through data, national and local, reviewed historical context and trends, and relied on my own and my team lead's personal experience with a combined 30 years in the real estate industry. Here are the factors I'm really paying attention to: inflation, interest rates, unemployment, the stock market's reaction to all of the above, and of course, inventory, or more specifically, lack thereof. Inflation is the true overall defining factor of the market right now. The rise of interest rates is the government's path to curbing inflation. Take a look at this graph. In 2022, we saw an unprecedented rate hike which cooled buyer activity massively, while at the same time seeing new inventory come to a near screeching halt. Once the Fed feels they have gotten inflation better under control, they'll continue to reduce the rates. Just a few months ago, the Fed plainly stated that they're willing to overhike the rates to get things under control and then readjust later. Do you want an expert tip? Follow the 10-year Treasury note to get an idea where interest rates are headed in the near future. Let's touch on unemployment now. This definitely is a media clickbait favorite. We've heard all the news surrounding this, and whenever it happens, employees become concerned. Something that is important to understand: the percentage of layoffs and how that impacts most people purchasing homes currently is minimal and has a minimal effect on the number of sales. The true impact will be centered around two things. Number one, the public perception of layoffs and how that affects local consumer confidence. And number two, the stock market's reaction to unemployment numbers that will be released in February. Either and or both of these can affect what happens. Now the curveball, especially here in Silicon Valley.
Whoa, what was that? Whoa.
Inventory. That's what that is. Inventory is not only low, it is dangerously low. Listen to these numbers. As of January 13th, 945 homes are for sale. Last year, we had 618 at this time, quite a bit lower, but you probably remember all the competition of last year. And in 2019, which is a very similar market to this one, we had 1,180. And how about this? In 2009, there were 5,392 homes for sale. That's 6 times as much for those of you who don't have a calculator handy. Supply and demand is basic economy 101. So, where are we heading?
Right now you can open them. We'll gaze into the crystal. What's this I see? A house with a picket fence.
Let's start by dealing with the elephant in the room. Since the free fall that started April 30th last year, we've seen prices drop 17 to 21% throughout the Bay Area. That's the false appreciation I discussed in past videos. Has the bleeding stopped, or will home prices drop even further? As inflation gets under control, interest rates will start to lower, which will increase loan applications and buyer activity. It's already started. As a matter of fact, this past weekend, we experienced 50 visitors in one open house, and a single family home in Fremont received 12 offers. Here are the two scenarios I can realistically see in our market heading into this year.
Yeah, let's do it. I'm pumped.
Number one, we don't get as strong of a grasp on inflation as we hope. Interest rates stay up, and the stock market has a significantly negative reaction to the unemployment numbers and a recession fear. This scenario causes a pause in the market and the first 2 quarters and negative consumer reaction, further slowing buyer interest and sales. In this instance, prices stay stable with no appreciation and even some possible depreciation, but nothing significant. The nothing significant is due to the lack of actual sales, because it doesn't provide a large enough number to cause a significant reduction in values. And homeowners with enough equity, record amounts currently, not having to sell unless they're experiencing a life event of some sort. Scenario number 2 gets interesting. The Fed feels they have a grasp on inflation, they lower interest rates about 1% or so, and inventory remains low. On top of that, home buyers get used to this new norm of interest rates and continue to jump back into the market after the last year's third and fourth quarter pause. Most people that wanted to buy and held off still want to buy. This takes us back to supply and demand. Buyers far exceeding inventory availability and multiple offers commence. Homes start selling with multiple offers. Thankfully, most buyers don't have that short of a memory and remember the ridiculousness of last spring. Homes selling for 20% over asking prices in some instances. Homes sell quickly for market value or slightly higher, but once again, with no contingencies. In this scenario, we start to see appreciation again, but you should expect that to be moderate. One caveat, if inventory stays dangerously low and buyer interest continues to build, we could return to the hectic Silicon Valley pace. Here's a quick chart that shows what the national experts are saying. Notice they even disagree, but there are no wild swings projected. Fasten your seatbelts, the roller coaster isn't over, and we can't quite see around the next bend. Due to these quickly changing times, I will be updating you on the market every month moving forward. I do want to end with a quote from David Stevens. So be advised that this may be the one and only window for the next few years to get into a buyer's market. And remember, as the Federal Reserve data shows, home prices only go up and they always recover from recessions, no matter how mild or severe. Long-term homeowners should view this market right now as a unique buying opportunity. One thing I can assure you of, real estate is a long game, not a short play. This current market is a tremendous opportunity, just like back in 2019. Our clients that listened to us and invested in the market back then are ecstatic. The ones that didn't are either still renting or simply beating themselves up for missing out. By the way, this is actually a normal market, so just relax. And don't be that guy. As always, I'm Adam with the Walker team at Intero, and I'm here to educate and navigate, not speculate and fabricate. If you want to work with an experienced, active, and data-focused realtor, just text me, call me, or email away. Thank you so much for listening to my take. Make 2023 your best year yet.